Joining us this morning, CFRA Research Chief Investment Strategist Sam Stovall has an S&P target of 4940. Sam, it's great to see you again. I'm seeing a lot of notes saying we're going to bring up our Q4 GDP numbers because of retail sales. It's clear that the consumer continues to spend, at least into the holiday season. That carryover might spill into Q1. Is a March cut now looking less and less likely?
Morning, Carl. Yes, I think so. We've been projecting that the Fed, it would be later and fewer is the mantra we've been saying, that essentially the Fed would start to cut interest rates in May of this year and then actually cut by 25 basis points in each of the final 3 quarters of this year. So certainly a later start to the Fed rate cutting program and fewer cuts than what the street is expecting right now, which in my opinion is a good sign because it means that we are headed for a soft landing. If we did indeed get rate cuts to start sooner and to have more aggressive rate cutting schedule, I think that would imply that there are real problems with the economy.
Sort of also adds to the retrospective looks at Waller's speech yesterday, right? I mean, it makes a little more sense given today's print.
Absolutely. And I thought it was interesting today with the retail sales number. It was sort of a damned if you do, damned if you don't, because had the retail sales numbers come in weaker than expected, I think people would have been worried that, oh, no, we are headed for a harder landing. Now that they came in slightly stronger than expected, people are worried that inflation will remain a concern and that the Fed will be cutting rates a little later. But that's pretty much what we have been embracing for a while.
Speaking of inflation, Sam, we continue to see tensions ratchet higher in the Middle East. How concerned are you that that could kind of bring back inflation in a meaningful way?
Well, that certainly is a wild card, Leslie. When we look at oil price forecasts for all of 2024, our expectations is we're going to be moving back toward the mid $80 per barrel area. So certainly a lot of weakness that we've seen so far with oil prices, and quite frankly, we're scratching our heads wondering if the oil price decline is really a forecast of what global economic trends are likely to be. But our feeling, again, is that while Germany has missed a recession, that we could end up seeing a little stronger and better GDP growth forecasts globally for the entire year.
So, Sam, given your target for year end, what parts of the market do you want to emphasize?
Well, history tells us that that following an up year, you want to let your winners ride. So we have maintained our outlook for communication services, consumer discretionary, and tech. We have added to this group the financials because our belief is that this sector is trading at a 15% discount to its average relative PE over the last 20 years. We're looking for sequential earnings growth over the coming year and believe that with the Fed starting to cut rates, that will be beneficial to the sector. I think that the market will have a hard time, however, breaking through the 4,900 and then 5,000 level without a lot of attempts at that. And that's why my forecast is a little below that 5,000 threshold.
Yeah. Well, certainly same dynamics happening with 4,800 lately, Sam. We'll see where we get as we move further into the year. Thanks. As always, good to see you. Sam Stovall.
Thank you.